Howdy, folks. Dr. Jeff Camarda, and bright and cheery, and for many of us somewhat chilly, early February morn, February 1st. And I've got an updated market analysis report, and I've got to really thank your chief investment advisor and chief investment advisor, Jonathan Camarda, Kimberly Camarda, doing a fantastic job. Spending enormous amounts of time regularly, pretty much every day, pouring through the market signals and information and helping us navigate what we think are going to be increasingly treacherous times. And this report is prepared. Those of you who know my brother know that he produces a wealth of information and a lot of facts and figures and words, and I've distilled it down to try to just give you the essence. So, but these are his words or his resources. So stocks finished a brutal month yesterday with a promising two-day rally, which appears to continue at least so far this morning, as the tech sector and the NASDAQ spearheaded the move. The major indices closed January clearly and fairly deeply in the red, but the benchmarks are now well above their panic lows from last week, which is good news, right? We've got a bit of a bounce. Let's hope it holds. I'm not optimistic it will, but let's hope. Treasury yields finished little change despite an overnight rally in rates, with the afternoon pullback helping the rally in stocks following a wild week in the Treasury market. And again, there's a lot of pressure for rates to go up. And as we'll comment in a moment about Chairman Powell's remarks, but at least we're stabilized a little bit for now, it seems. Chicago PMI handily beat expectations, and this is a manufacturing manager's business expectations index, which is good news despite Omicron, which has dampened business activity. The measure is pointing to healthy growth in that sector. Hopefully it continues, and manufacturing continues to do well and be profitable. The S&P 500 surged above its 200-day moving average, with the Dow also closing slightly above its long-term indicator thanks to two-day bounce in stock. May it continue, but remember that often, stocks never go straight up or straight down. We went down pretty severely in January. We've got a bounce here. It may be just a temporary pause in an overall downward trend, what some folks call a dead cat bounce, but you just don't know. So you have to really watch very carefully and make decisions based on the data as they present. Powell said was very positive on the labor market. Obviously, this is like the tightest labor market in my lifetime. And so much so that he stated there is quite a bit of room to raise rates without dampening employment. That certainly will dampen economic spirits, so I think. Regarding recent market volatility, also, this is kind of bearish. Fed chair had been dismissive of the recent pullback and, in fact, endorsed the tightening of financial conditions, and devil may take the stock market. And also, he did not rule out a hike at every meeting, which is going to be pretty, the severe clockwork increases, ratcheting up interest rates, adding that this cycle is unlike previous cycles, which again is fairly hawkish from an economic standpoint. They're putting the foot on the brake. Rates go up, you dampen economic activity, and so forth. So stocks, returning to Jonathan's comments, had their most volatile week in nearly 2 years as inflation and rate hike fears triggered a tech-led mini crash just on Monday, setting the tone for the entire week. Hopefully that's going to abate somewhat. And again, this is last week, I think. The major indices all hit multi-month lows, while small caps dropped to their lowest levels in over a year, and the risk off shift despite the improving global COVID outlook and mostly bullish corporate earnings. While stocks finished the week on a positive note, again last week, despite the Fed's hawkish rhetoric, the majority of stocks still closed lower for the fourth straight week, with 2022 kicking off in a decidedly bearish fashion. The week's economic releases lean bearish again, especially the most forward-looking indicators. Analysts agree the weakness will likely be temporary as the Omicron wave is expected to ease its grip in the U.S. and really worldwide very soon. The technical picture, the chart outlook for the stock market remains the weakest since the COVID crash, with especially the tech sector and the NASDAQ showing bearish signs due to the surging rate hike odds and other stressors like overvaluation. The S&P 500 are down, and NASDAQ are all way below the 50-day moving averages. and the benchmarks also closed last week below the 200-day moving average. Again, we had a nice bounce so far this week. Small caps failed to build up relative strength despite being extremely oversold, and the Russell 2000 finished a week deep below its moving averages while entering bear market territory. And I mean, the volatility is important. VIX briefly took out its December high, nearly topping the 40 level, but the fear gauge behavior remains more consistent with an ongoing bull market than a full-blown bear market despite this week's spike. But investors are concerned. The number of new lows also declined. So you know where this information is coming from, I've asked Jonathan and Kim to report just a digest. Again, not to gush a lot of detail that you probably don't care about, but just the basics at the beginning of each trading day and the end of each trading day. And what I'm reading is his report from early yesterday, Monday, before we saw the market action yesterday. But my comments, many of which I emailed to you, I think, last week, or the markets really have become extremely unstable, and they could be on the verge of a major crash. I hope not, but they could be. So what are we doing about this? In January, you may remember, just a week or so ago, we sent you a Camarda Portfolio Protection Action Report. Since December, when several of the indicators we track went negative, we've been selectively trimming specific positions, going to cash or to other more promising sectors. Recently, and this is probably 10 days-ish ago, that we raised more cash and adding some attractive asset classes like gold. Again, we're doing this to preserve investment values as the markets appear to be increasingly unstable and a risk of a major meltdown. Will it actually occur? I don't know. I hope not. Certainly hope not. But we want to be prepared on an incremental basis. So as things appear to darken a little bit, we take a few chips off the table and reposition them, and then continue to play the game as it unfolds. As Kim is very fond of saying, we're basing our decisions not on what should be. Stocks should be much lower because of this and this and this. That doesn't matter. That the market's kind of marching their own drum. So not on what they should be, but what is. And we read the tea leaves of what is on a very regular basis and make adjustments to protect your portfolio through what we think are some pretty dark times ahead. So segueing, by the way, thank all of you that have read my book now and posted an Amazon review, but it's kind of scary how many of the predictions in here about raging inflation, market instability, tax increases, this thing with Russia, I talked about the increasingly unstable world, the geopolitical world stage, are coming true. And I would really appreciate, if you haven't yet, if you could take just a moment to please go to Amazon and post your review, even if you thought it was horrible. To say what you think. I don't think you will. But please take just a few moments. I'd really appreciate it if you go to Amazon and post your review. And that, for the nonce, is all I have to say about that. And we will, be watching the markets very carefully. My ear will be to the ground listening for hoofbeats. And if it makes sense to get some more information out to you by a video or other means, this week we surely will. We are in high alert, and we are here to stay in close communication with you. Thank you so much. God bless you all. Thanks for your time. Talk to you soon, we hope. Bye-bye.